For most of last year, the global economy felt oddly calm. Inflation was coming down, stock markets were near record highs. Headlines quietly started using the word soft landing. And then, almost overnight, that calm began to crack. Currencies wobbled, bond markets twitched, central banks changed their tone. Big companies started whispering words they hadn't used in a while: uncertainty, volatility, fragile. Nothing has collapsed, nothing has exploded, but the global economy suddenly looks shaky. Not in a dramatic, movie-style crash way, in a slow, uncomfortable, something isn't lining up way. And those are usually the moments that matter most. Here's the strange part. If you look at the surface-level data, things don't look terrible. Unemployment in many countries is still relatively low. GDP numbers are positive, even if they're smaller than before. Consumers are still spending. So why does it feel like everyone, from governments to investors to CEOs, is quietly bracing for impact? Because the global economy isn't driven by vibes, it's driven by math. And right now, the math is starting to look uncomfortable. The system we built. To understand what's happening, we need to zoom out. The modern global economy runs on a simple idea: borrow now, grow later. Governments borrow, companies borrow, households borrow. Debt isn't a bug, it's the fuel. After the 2008 financial crisis, that fuel got cheaper than ever. Interest rates dropped close to zero in much of the world. Money became easy, almost too easy. Borrowing felt painless, refinancing felt smart, risk felt manageable. And for over a decade, the system adjusted itself around one assumption: interest rates would stay low for a very long time. That assumption quietly shaped everything: housing markets, tech valuations, government budgets, startup culture, stock buybacks, even the way countries managed their debt. Low rates weren't just policy, they were the foundation. Then, inflation broke the spell. And inflation arrived. Not slowly, not politely, suddenly. Pandemic disruptions, stimulus spending, supply chain chaos, energy shocks. Prices started climbing faster than central banks expected, and faster than they could ignore. So they did the one thing the system hadn't seen in years. They raised interest rates. Fast, aggressively, almost everywhere. And this is where the shakiness begins. Why higher rates change everything. Interest rates are not just a number on a screen, they are gravity. When rates rise, borrowing gets heavier. Old assumptions stop working. Weak structures start to creak. Think about debt like this. If you borrowed when rates were near zero, your entire financial model was built on cheap money. Low monthly payments, high leverage, thin margins. Now imagine refinancing that same debt at double or triple the cost. Nothing breaks instantly, but pressure builds. Governments feel it first. Higher rates mean higher debt servicing costs. Money that used to go to infrastructure, healthcare, or education now goes to interest payments. Companies feel it next, especially companies that relied on constant refinancing or cheap credit to survive. And households feel it last, but often the hardest. Mortgages reset, credit card interest jumps, monthly budgets quietly tighten. This is how economic stress actually spreads, not through headlines, through spreadsheets. The bond market is whispering. If you want to know how nervous the system really is, don't watch stocks, watch bonds. Bond markets are where the serious money lives. Pension funds, central banks, insurance companies. And recently, bond markets have been acting strange. Long-term government bond yields have risen sharply in several major economies. That means investors are demanding more compensation to lend money far into the future. Translation: they're less confident about stability. At the same time, yield curves have inverted, short-term rates higher than long-term rates. Historically, that's one of the most reliable warning signs of economic slowdown, not because it predicts disaster, but because it reveals tension. The market is saying, we don't trust the short term, and we're unsure about the long term. That combination is rare and unsettling. The growth illusion. Here's another uncomfortable truth. A lot of recent growth hasn't come from productivity, it's come from leverage. Companies didn't just innovate, they borrowed cheaply to buy back their own shares. Governments didn't just grow tax bases, they ran deficits at historically high levels. Consumers didn't just earn more, they leaned on credit. As long as money stayed cheap, this worked. But higher interest rates expose the illusion. Suddenly, profits shrink, deficits matter again. Debt stops feeling abstract. Growth that was pulled forward from the future now has to be paid for in the present, and the bill is arriving. China, trade, and quiet slowdowns. Zoom out further, and the global picture gets more complicated. China, the engine of global manufacturing and demand, is slowing, not collapsing, slowing. Real estate stress, demographic decline, lower consumer confidence. At the same time, global trade is fragmenting. Supply chains are becoming regional. Geopolitics is interfering with efficiency. This isn't a crisis, but it is a drag. The world built an economic model optimized for speed and scale. Now it's being redesigned for resilience and security. That transition costs money and growth. Why markets still look calm? Because financial stress rarely announces itself loudly at first. It hides in technical language, in revisions, in guidance changes, in slightly weaker forecasts. Markets are still betting that central banks will eventually cut rates, that inflation will stay under control, that growth will slow but not snap. Maybe they're right, but notice the contradiction. Rates stay high because inflation risk isn't gone. Growth stays weak because rates are high. Debt stays heavy because growth is weak. That loop is hard to escape. The psychological layer. There's also something less visible happening. Confidence is fragile. Businesses delay hiring. Consumers delay big purchases. Investors become selective instead of optimistic. The economy doesn't fall off a cliff, it hesitates. And hesitation spreads. That's why the global economy can look fine on paper and shaky in reality. What this means going forward. This doesn't guarantee a recession, it doesn't guarantee a crash, but it does mean the era of effortless growth is over. The system is adjusting to a world where money costs something again, where debt matters, where assumptions are tested instead of rewarded. Some parts will adapt quickly, others won't. And history suggests when pressure builds unevenly, something eventually gives, often in places no one was watching closely. Ending. Unresolved question. So here's the real question. Is the global economy strong enough to absorb higher rates, slower growth, heavier debt, and geopolitical tension all at the same time? Or have we been mistaking stability for balance and calm for control? Because the most dangerous moments in economics are rarely loud. They're quiet, they're technical, and they arrive while everyone is still arguing about whether anything is wrong at all.